Hi everybody. In this video, I'm going to talk about wealth tax and the new Spanish solidarity tax and why they may not be as bad as you think they are. So if you're ready, let's go. So this is a presentation that I've given at work, and it's based on our information and discusses why Spanish wealth tax and solidarity tax might not be as bad as you think they are. So in this video, I'm going to talk about how wealth tax and solidarity tax work together, why the level of your income is very important when it comes to working out how much you will be paying in wealth tax, how you can reduce your level of income and there in turn reduce the amount of wealth tax and solidarity tax you may be paying, and then summarize and give you an overview of what we discussed. So let's talk about wealth tax and solidarity tax. They tax the same thing. There's only 5 countries in the world that have a wealth tax. That is Spain, France, Norway, Colombia, and Switzerland. And the new solidarity tax is a bit of a worry because they've said it's only going to be in place for 2 years, but they said that wealth tax was going to be temporary back in 1978, believe it or not. They only introduced wealth tax as a way to boost their income for after the Franco years. And it was zero rated between 2008 and 2011, but it's been fully taxable since 2011. The Partido Popular, the right-wing party of Andalusia, reduced Andalusia wealth tax down to zero back in September last year. And about a week later, the central government, in Madrid, PSOE, the left-leaning socialist party, introduced solidarity tax. So you can see that wealth tax and solidarity tax are political footballs really between the right and left-leaning parties of Spain. Where you live in Spain depends on whether you pay wealth tax or solidarity tax, and you can offset how much you pay between wealth tax and solidarity tax between the two. You only pay the larger tax. And they are taxable on individuals. So that's to say, a married couple would be better off probably having their assets owned jointly, as opposed to having all the assets in one spouse's name, as opposed to the other spouse not utilising any personal allowances they may have. So the assets that are taxed. Essentially, obviously, property is taxed. There is a €300,000 exemption. Investments, bank accounts, work of arts, jewelry, annuities. Annuities are given a capital value that is calculated. There's a calculation for that. Pension funds are a little bit complicated. Pension funds, there's arguments to say that non-EU pension funds are subject to wealth tax. There are people that say work-based pensions are not subject to wealth tax, but non-work-based pensions could be. So it is quite complicated. Our advice would be to speak to your accountants and find out what their local tax office thinks whether these assets should be taxed or not. And family company shares that you may own, that you may have a private company that you've worked in for many years, those large shareholdings will be exempt. So the wealth tax rates, like I say, it's been abolished in Andalusia and Madrid. There is a €300,000 main home exemption and a €700,000 exemption elsewhere, except in the Comunidad Valenciana and Catalonia, where it's only €500,000. And you can see on the table here that the tax rates are start at 0.2, 0.3, 0.5, 0.9. So not significant until you get into the millions above the exemption. So around 2 million, you start paying significant sums and gets into the thousands of euros. And it goes all the way up to 3.5%. Solidarity tax, same exemption, so the 300,000, 700,000, but there is a zero rate of 3 million. So you have to have wealth individually of over 4 million to start paying this tax. So solidarity tax is actually going to affect very few Spanish taxpayers. It's reckoned that it will only affect 23,000 people. So probably not something that most people are going to need to worry about. But the sums do get significant for very, very wealthy people. As you can see, once you get above 10.5 million or so, you are paying a rate of 3.5% on solidarity tax. So what I've done here is I've run through an example of how this works. We're looking at Mr. Smith. He has €1 million, €1 million of Spanish property, €500,000 of UK property, and €4 million in investments in cash. Now, just from the information you've been given so far, wealth tax has a million exemption, so it works out that he would pay €56,946 in wealth tax. On solidarity tax, he will pay a tax of 25,500. So if he lives in Andalusia and Madrid, he pays 25,500. In the rest of Spain, he will pay 56,946. Remember, he only pays the largest sum. Now, a little bit more information. This is where your income, it becomes very important. There are some limits on the amount of tax you can actually pay in income, combined income and wealth stroke solidarity tax. It can't be more than 60% of your income. That said, you must pay 20% of the wealth or solidarity tax tax bill. So you can see in that scenario, if you can reduce your income down to a point where your combined wealth tax, solidarity tax, and income tax is less than 60%, then you can reduce your tax quite significantly. You could do that by maybe having a flexible drawdown pension and reducing the amount you draw, and you could maybe increase your drawings from investments. You could also look at something we call a Spanish tax compliant bond, and I will come on to that in just a minute. So, Mr. Smith again, we know that he's going to pay 56,946 in wealth tax or 25,500, but his pension income is 15,000 euros per annum, and his investment income, he's got 4 million euros invested, so his investment income of 2% gives him a further 80,000. So in that scenario, he's got 95,000 in income. We've worked out that his total income tax will be roughly 35,000 euros. That's just an indication. I've not done a firm calculation. So his bill would be 91,946. But because he can't pay more than 60% of 95,000 euros, this reduces the bill down to 57,000 euros. Same with solidarity tax. If he lived in Madrid or Andalusia, you can see there that his solidarity tax calculated with the income tax works out at 60,500. So in Madrid or Andalusia, because he's only allowed to pay 60% of his 95,000, that reduces it down to 57,000 euros. Please bear in mind this income tax figure hasn't been calculated. It's just to show you the way that this tax calculation works. So, if we were to, this example gives us the way that if we were to invest that 4 million euros into a Spanish tax compliant bond, which would produce no income. So what it does is you put the 4 million euros that he has invested in cash and other investments and put that into a Spanish tax compliant bond. He can still draw 80,000 euros, pay very little tax on that in the first year for certain. I'll come on to how a Spanish tax compliant bond is taxed. But what it means is that his only income now is 15,000 euros in pension. So he pays around 500 euros in tax on that. He has 60, obviously he's limited to 60% now on wealth tax or solidarity tax. So that's 9,000 euros. Um, but because he has to pay 20% of the wealth tax or solidarity tax, remember we're stepping down to the next level, his actual bill in wealth tax will be 11,889 euros. In Madrid or Andalusia, he would pay the 9,000 euros because he has to pay the 60% of his income. So in that scenario, outside of Madrid and Andalusia, by investing in the Spanish tax compliant bond, he's going to save himself 45,111 euros per annum, or 48,000 per annum in Madrid or Andalusia. So you can see that a Spanish tax compliant bond has a lot of advantages for wealthy people when it comes to saving them both income tax and wealth and solidarity tax. So let's talk about what a Spanish tax compliant bond is. Generally speaking, they're not based in Spain, based in Luxembourg or Ireland. You can invest in a wide range of assets. So that would be, stocks and shares, bonds, property funds. There is gross rolled up within the bond. So this is what gives the bond the tax advantages. Any income that's produced by the investments do not suffer tax. There's no income being naturally produced. You only pay tax when you make a withdrawal from the bond, and it's only on the portion of the investment that is growth. So I've done a scenario here. If you invested €1 million and that grew to 1.25 million, you can see in that scenario that now a fifth of your money, 20%, is growth. So if you were to withdraw 10,000 euros, 2,000, fifth, 20% is growth, and that's taxable at 19% when you make that withdrawal. So you pay tax of 380 euros in that scenario. And because it's a life insurance bond, and it will pay out directly to your beneficiaries on death, so you can stipulate your beneficiaries before you set it up. And if your beneficiaries are outside of Spain, because it's based in, like say, Luxembourg or Ireland, that it will avoid Spanish succession tax as well. So in summary, wealth tax affects individuals with more than a million euros in assets. Solidarity tax will affect those with more than 4 million. Bear in mind, you want to probably equalize your wealth before you move to Spain, because Spain has gift tax depending on the autonomous region. There are 17 different autonomous regions in Spain, so it can vary quite significantly how much gift tax is payable. And if you can reduce your income, either by flexible drawdown, reducing the amount you draw from your pension, or by investing in a Spanish tax compliant bond, then this will help a great deal. And that, my friends, is the end. Thank you for your time. If you have any questions, please put them in the comments below, and I'll try and help if I can. But thank you for your time. Adios.